Welcome back to Accrued Interest. Today, in this episode, we're going to do part 2 of our deep dive trying to understand what's going on with FuboTV. First, our usual disclaimer, everything said on this podcast is for entertainment and educational purposes, and nothing here should be considered investment advice, as I am not a registered investment advisor. For this video, I wanted to show you how a Wall Street analyst, either on the buy side, the sell side, or just any side, analyzes a quarterly earnings report. I'm going to use FuboTV as an example, but you could apply this framework to any company that you're looking at in your portfolio. I want to go over 3 things you should keep in mind when analyzing a quarterly earnings release. First of all, you should try to hold off on making any value judgments to the end. This can be difficult because if you hold the stock, you might be inclined to stay long, or if you're short, you might be inclined to only listen for negative things that conform to your prior expectations. Secondly, don't take management commentary at face value. You want to be as skeptical as possible and try to read between the lines to get to the true story at hand. Thirdly, you want to consider not what you want to see the company do, but what would other investors need to see the company do or say in order to make them want to buy or sell the stock. I'm going to spoil the ending a little bit right here. FuboTV announced earnings a little less than 2 weeks ago on February 28th. Suffice to say, the market was not happy. The company was trading around $4 a share, and then it precipitously dropped to around $3 a share. Such a steep decline is basically Mr. Market's way of saying, we don't believe you. You need more people. You need to show us something to make us change our currently bearish stance on the company if you want us to buy the stock. For those of you following along on YouTube, most of my graphics that you see here are coming from 2 documents that you can get from the company's website. I'm going to be quoting pieces from the company's press release following Q4 earnings, as well as a shareholder letter. I'm not going to be talking about the annual report because I want to focus on what just happened in the last 3 months of the year so we can extrapolate into 2025 and then begin to wonder what else we need to see once we bring Hulu in the mix. Right off the bat, let's dive into revenue. The first thing that jumps out at me is that subscription revenue is up, but ever so slightly. That's good. We'd rather it be up than down. But subscription revenue is significantly larger than advertising revenue. The company in Q4 did approximately $407 million in subscription revenue. Comparatively, they did only about $34 million of advertising revenue. Advertising is less than 1/10 the size of subscription revenue. This is going to put a little bit of a ceiling on the company's growth rate because subscription revenue, particularly for a skinny bundle, is mostly going to grow as you add new subscribers. Subscription revenue is difficult to grow through price increases for these over-the-top TV packages because a big reason that the subscribers came to Fubo in the first place is because they did not want to pay the high prices they're paying for cable. Advertising revenue has the potential to grow significantly faster than subscription revenue because advertising revenue is not coming out of the pockets of your subscribers. This is an area where Hulu could potentially be a big help to Fubo because I know from experience that Hulu has a much higher advertising mix in their revenue base. I want to draw your attention to another metric that we're going to be quoting extensively in this podcast: average revenue per user, ARPU. Lots of subscription companies use this metric. ARPU is growing ever so slightly, but it's relatively flat for the most part. In Q4, the company did almost $88 per month per subscriber versus about $87 in the prior year's period. In the next couple slides, we're going to separate the customer base between the North American subscribers and the rest of the world. For the sake of Fubo, they categorize rest of world, or other companies would just call this international, as their business in Canada, Spain, and France, where they operate under a different service name called Molotov. This next chart breaks out North America and the international segments. Number 1, the North American subscribers are about 1.7 million, which is up about 4% year over year, but relatively flat over the last 5 quarters. The North American sub amount has bounced around between about 1.6 million and 1.7 million, but it even dipped as low as 1.4 million in Q2 2024. This sort of movement in the subscriber base suggests that there is seasonality in FuboTV's business. My guess is that because the service is geared mostly towards sports fans, you're probably having subscribers come on and come off when their favorite sport is in or out of season. Number 2, the ARPU has also been fairly consistent in the high 80s over the last 5 quarters. Again, this makes sense because the company can't raise prices too aggressively without losing subscribers, and their advertising business has been a bit anemic, to say the least. Number 3, for the rest of world business, we see that it is about 20% of the total subscriber base. In Q4, they had about 360,000 subscribers in the international segment. Now, this is down about 11% over last year. Looking at the trends for the last 5 quarters, the international subs are clearly in decline. We want to see if this can reverse in the future. As far as international ARPU, the international subs are punching way below the weight of the North American subs. North American subs, remember, had about $88 per month on average. The international ones have about $8.50. They are monetizing the international subs at less than 1/10 of what they're getting for the North American subs. Something that management wanted to highlight was that in this quarter, FuboTV was free cash flow positive. They had about $16 million for the quarter. In the press release, management called out that they generated about $21 million from cash from operating activities. Putting our accounting hat back on, let's bridge between the income statement and the cash flow statement. The company actually had negative net income, but positive cash flows for operations, meaning that the change in working capital was what drove the beat. Focusing back on net income, as I said before, Fubo had approximately negative 10 million in net income for the quarter. This is much better than the negative 50 million in net income they had this time last year. I also want to draw your attention to the shares outstanding. This number has actually been going up. Last year, Fubo ended the year with about 294 million shares outstanding. As of last quarter, that number was around 336. So you as the equity shareholder are actually having your ownership interests slightly diluted away as the company issues more shares. We'd like to see this number be at least flat or ideally shrink and go in the opposite direction. A big reason why the stock fell immediately after earnings was that Q1 2025 guidance was deemed underwhelming by the market. The company called out that they're projecting a positive revenue growth of about 3% next quarter. However, they're also forecasting a negative 4% decline in total subscribers. For the rest of the world, that segment is shrinking even more. They're forecasting a negative 5% in revenue for next quarter and a negative 16% decrease in subscribers. In the management commentary, they had a clear culprit for why they're expecting North American subscribers to shrink. At the end of 2024, Televisa Univision was not able to come to an agreement with FuboTV in terms of what was a fair price that Fubo was going to pay for the channels that they carry. FuboTV, on one hand, is saying that Televisa Univision is forcing its subscribers to take channels that they don't want. They also were accusing Televisa Univision of trying to push a 25% increase that ultimately would have to be pushed on to the subscribers. Televisa Univision, on the other hand, would counter that Fubo is refusing to pay the market value that other video distributors had agreed to. This comes back to a point I mentioned in the first Fubo video about the MFNs, the most favored nation clauses. Televisa Univision is basically saying, Fubo, I'm sorry, we cannot give you a discount to the other deals that we are cutting in the market. Yesterday's price is not today's price. We'll dive deeper into Hulu plus live TV in future videos, but this is where Hulu needs to help Fubo. With the increased scale, investors are hopeful that Fubo, with over 6 million subscribers should the deal close, be able to attract more high-margin advertising revenue to make up from the sluggish ARPU trends. An issue that we're going to have to watch for the remainder of 2025 and beyond is whether or not other channels in the Fubo packages are also going to want price increases that Fubo can't stomach, and ultimately, will Fubo have to drop other channels? Digging deeper, reading between the lines of the Q1 guidance, we were able to discern that the company unfortunately is relying too much on ARPU growth to drive revenue forward. In the next quarter, management forecasts that revenue at the midpoint is going to come in at about $405 million. They're forecasting North American subscribers between 1.43 million and 1.46 million. What Fubo is telling you is that they expect the ARPU for the North American subscribers to be about $93.43 on a monthly basis. Putting this in context, that is up about 11% from Q1 last year. The bears could argue expecting such a large ARPU increase might be a little unrealistic. Fubo would argue, on the other hand, that the ARPU is going to be higher because they're saying goodbye to the less profitable customers that were only here for the Univision packages. In order for the market to believe what management is selling at Fubo, 3 things need to change in 2025. First, subscriber growth needs to accelerate. Secondly, the advertising revenue should be a much larger mix of the total revenue pie. And thirdly, free cash flow needs to come from positive net income and not just changes in working capital in order for the stock market to give the stock credit for these improvements. As always, thank you for listening. Don't forget to like and subscribe to the channel. Stay tuned for future updates in this Fubo series. Next, we're going to analyze what the expected impact is going to be from the Hulu acquisition, and we're going to bring it all together and come up with our own price target so you can be smart about investing in the stock. Thank you again for listening.